Choosing the right business structure for your real estate investments can mean the difference between personal financial disaster and long-term wealth protection. When it comes to LLC versus LLP for real estate, understanding the key differences is crucial for making an informed decision. Limited liability companies and limited liability partnerships both offer protection, but they're not created equal for real estate investors. LLCs have become the preferred choice for most real estate investments, offering greater flexibility, stronger liability protection, and favorable tax treatment. Let's break down why this matters. When you own property as an individual or in a general partnership, you face unlimited liability. This means if someone is injured on your property and successfully sues, your personal assets, your home, bank accounts, and possessions are all at risk. Both LLCs and LLPs can shield you from this exposure, but in different ways. With an LLC, all members receive liability protection. The company itself becomes the legal owner of the property, and your personal liability is limited to your investment in the LLC. This makes LLCs particularly attractive for rental and investment properties. LLPs, on the other hand, require at least 2 partners and typically only protect limited partners from liability. General partners may still face personal exposure unless additional structures are put in place, such as using a corporation as the general partner. The management structure is another important consideration. LLCs offer flexible management options. You can choose member management, where all owners participate in decisions, or manager-managed, where designated individuals handle operations. In many states, you can even form a single-member LLC, making it ideal for solo investors. Limited partnerships require at least 2 participants. 1 general partner who assumes personal liability, and 1 limited partner. This structure is less flexible for individual investors, but can work well for certain partnership models. When it comes to taxation, both entities offer advantages over corporations. Unlike C corporations, which face double taxation, LLCs and LLPs use flow-through taxation, meaning profits are only taxed once at the individual level. This can result in significant tax savings, especially when dealing with appreciated property. For rental properties generating passive income, an LLC structure generally works best due to its flexibility and liberal distribution rules. Members receive a K-1 form and pay taxes on profits as personal income. However, if your real estate strategy involves actively flipping properties, buying, remodeling, and selling within a year, the IRS may consider this an active trade or business subject to self-employment tax. In this scenario, an S corporation structure might be more advantageous than an LLC, as it allows you to pay yourself a reasonable salary subject to employment taxes while taking additional profits as distributions, not subject to self-employment tax. Privacy is another factor that often gets overlooked. LLCs typically offer better privacy protections, especially in states that allow anonymous ownership filings. Real estate investors wanting to limit public exposure of their names can use nominee services or trusts with LLCs. LLPs usually require partners' names to be filed publicly, reducing privacy. For raising capital, both structures can accommodate investor contributions, but LLCs offer more flexibility in structuring equity ownership and profit distribution. LLCs allow disproportionate allocations of profit, making them ideal for syndications and complex investor agreements. It's important to note that laws governing these entities vary by state. Some states don't recognize LLPs for real estate investment purposes. Others, like California, impose minimum franchise taxes on LLCs, regardless of income. States like Florida and Delaware are popular for real estate LLCs due to favorable asset protection laws. LLCs also typically provide stronger protection against creditors. In most jurisdictions, creditors of an LLC member can only access the member's interest in distributions through a charging order. They cannot force the sale of LLC-owned real estate. To summarize, LLCs are generally the preferred choice for real estate investments due to their liability protection for all members, management flexibility, favorable tax treatment, and stronger asset protection. LLPs can be useful in specific partnership scenarios, but carry more risk for general partners unless additional protective structures are implemented. Before making your final decision, consult with an attorney specializing in real estate law in your state, as regulations and tax implications can vary significantly across jurisdictions. The right structure will depend on your specific investment strategy, whether you're investing alone or with partners, and your long-term financial goals.